The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. I'm Michelle Hebert, Director of Communications here at SAANYS, and I want to welcome you to another Lunch and Learn in our Financial Friday series. SAANYS is excited to offer these sessions in cooperation with our corporate partner, AXA. AXA has a long-standing presence in New York, and a large portion of AXA's New York client base is built upon the work they do within the public education system. Through AXA, SAANYS members can receive competitive insurance rates and a full array of retirement services, including a complimentary financial profile for SAANYS members. And this is a great benefit, so we urge you to take care of that or take advantage of that. Our AXA presenter today is Greg Podgorski, Vice President and Financial Planner for AXA Advisors out of the Clifton Park office in Saratoga County. Before we get started, please note that all participants are muted during this session. That's because there's so many people online today. However, there'll be some time at the end for Q&A. So just type your questions in the question box in your control panel, and we'll get to those at the end of the presentation. So with that, I'll mute myself and turn the presentation over to Greg.
Perfect. Thank you, Michelle. So welcome, everybody, and thank you for attending today. I know we got a very good response rate to this topic, which just means a lot of people, especially this time of year probably, are thinking about retirement and when they no longer have to show up to work, but how they can still collect the payment. And so a lot of what we're going to go through today are some ways that we can enhance the pension benefits that you have through the teacher's retirement system and ways to maximize what those future benefits will be. So a few things before we get started. We will put up a contact list at the end for anybody who does want to reach out to their local representative for any individual questions that are a little bit more specific to an individual situation. We can definitely defer those to private meetings or private discussions afterwards. But for any general information or basic questions, we will do a Q&A question session afterwards. So as far as what we're going to cover today, we do believe it's very important that our educator clients, and especially our SAANYS members, understand how the pension benefits through New York State work. So we'll go through a quick overview there, and then ultimately some of those decisions you will all be faced with. Those are going to be things that for some of you might come pretty soon down the road. For some of you, you might have some more time to plan. But there are a lot of different things that we can address, whether we're closer to retirement, whether we're a few years left in the working world. But again, those are all things that we'll be able to talk about. And then some points to consider when we look at alternatives to some of the options that New York State gives us, and then ultimately how those decisions that we will be making, how those will impact the future income expectations through TRS. So again, just to go through a quick overview here, we always find it important to educate our clients and again our SAANYS members about how their TRS pension benefit is ultimately calculated. So there's three basic requirements that TRS is going to look at once that time comes. They're going to look at your age at retirement, they're going to look at your total years of service, and your final average salary. There's a couple important key milestones that TRS has as a part of this calculation. So one of those milestones is age 55. So age 55 allows a TRS member to retire and begin receiving their pension benefits as long as they've hit the minimum service time. There's also the requirement of 30 years of service. Now, say that that's a requirement. In our eyes, from a financial planning perspective, it's always something that we should strive for with our total years of service. But having hit age 55 with 30 years of service allows a TRS member to retire without any early retirement penalties. All right, there's also another stipulation there of age 62 with less than 30 years of service. All right, so if someone were to retire with 28 years of service at age 62, they would not be penalized for not hitting that 30-year of service benchmark. All right, so again, a few important distinctions there, but we do get a lot of questions from some participants who are maybe 57 years old with 29 years of service. There's a huge financial incentive for the rest of your lives to make sure that you don't give up a big portion of your retirement benefit or what you're ultimately entitled to. The final average salary, a quick note on that. So New York State mandates, and these are general guidelines applicable to all Tier 4 members, which we were assuming most of our RSVPers were going to fall into the Tier 4 membership category. But with the final average salary, the way that TRS looks at that, it's your highest 3 consecutive years. And there's a caveat in there, and a pretty important one. So if the last 3 years of working are 90,000, 90,000, 100,000, what TRS will actually do in that final average salary calculation, they're going to kick out that $100,000 final average salary number as an income benefit, because it was more than 10% of the previous 2 years. So there's an important distinction there to make sure that, again, what your final average salary is are the last couple of years of working fall in line with the parameters of how TRS is going to calculate that maximum benefit for you. As far as the benefits go to the New York State pension, so New York State does have one of the best funded pension programs in the US. Again, that's something that we always reiterate. It is a guaranteed lifetime income. Guaranteed is in quotes, shouldn't even bring this up, but we did just pass the Constitutional Convention for New York State. Again, nothing that we have to worry about right now, but again, that's where guaranteed is somewhat in quotation marks there. But again, for all intents and purposes, we don't ever anticipate something changing on that front. But again, on the legal side, it could. Typically, the largest source of retirement income is the New York State pension for a lot of our TRS members. Again, that's when we maximize benefits, when we hit some of those age and service requirements. But again, that's a huge benefit that you're all entitled to. We want to make sure that our clients and our SAANYS members are maximizing what their benefit options are. Another big component is the consistency of that monthly paycheck, the stability that it provides to the retirement income household finances, and then a lot of peace of mind. A lot of clients that we work with that don't have a pension, they're susceptible to dealing with all the ups and downs of the stock market. Again, the stability of the New York State pension allows the ebbs and flows of the stock market, the volatility that we can experience from time to time, to be a little bit more muted, because we do have that consistent, we have that fixed income source that is very secure. However, as good as the benefits are, there are a few challenges with the New York State pension system. After 30 days of retirement, we can no longer go back and change any of the elections that we made. We can't change the single life to a survivor option. We can't change from a survivor option to a single life. We can't change beneficiaries ever again. So it's a very inflexible system after 30 days of retirement. Again, nothing can be changed regardless of any personal needs, any income needs, family or marital changes that may happen in retirement. So again, one of the difficulties there. The New York State pension also has a very low cost of living increase. The cost of living increase doesn't start for 5 or 10 years into retirement. And once it does start, it's capped on the first $18,000 of your pension benefit. So on the low end, once that cost of living increase starts, it's a minimum of a $15 a year increase. I'm sorry, $15 a month increase. At a maximum, it's $45 per month. So if a SAANYS member generally is retiring with about a $60,000 single life pension, we're at a maximum of a $540 a year increase to that pension benefit. It doesn't keep up with cost of living needs, and very rarely keeps up with inflation. So it is one of those downfalls there that we address and we plan for. To provide lifetime income to a spouse or a significant other, we can actually take a 10 to 20% permanent reduction in that pension as well. So again, there's some planning ideas that we'll share with you today to address that. There's no pension if a New York State employee or a TRS member passes away before retirement. Very important distinction there, not always known by a lot of our clients and SAANYS members. But if we don't make it to retirement, there is an in-service death benefit, but that death benefit does not cover what that pension expectation would have been. So again, some planning topics there. There's also a permanent reduction if the age and years of service milestones are not met. So again, if we have a client who's retiring at 55 without 30 years of service, they're going to take a 27% hit right off of the top of their pension. If they're also trying to provide that lifetime income for a spouse, they could take another 20% hit. So it can be a very, very big financial downfall to retire without hitting some of those milestones. Just to give everybody an idea of what those pension options look like with New York State. Again, a lot of our SAANYS member clients are retiring with about $100,000 final average salary. Assuming we hit that 30 years of service, that would mean that their single life pension option would be $60,000 per year. That's what they're entitled to. But as you can see, there's a whole array of different options that New York State gives you. It's our job to help our clients decipher what makes the most sense in the financial situation. But as you can see here, the joint allowance option will skim about $7,000 to $8,000 right off of the top of that pension, just to provide that benefit to a spouse or a significant other. So with the planning ideas that we have and that we utilize for our clients, these are all the things that we look at as ways to maximize those benefits as our clients are both living. And then what, God forbid something were to happen to one side of the household, how do we make sure that that income is still protected for both the spouse and potential children or the family by doing some legacy planning in there as well. So there are a lot of different things here. We'll jump into a few of these descriptions in just a few minutes. But again, just wanted to give a quick overview of what the pension is, how it's calculated, what goes into that determination, and then ultimately what the options are. So once retirement happens, there's a lot of decisions that need to be made, right? Or as we get closer to the retirement time frame, there's a lot of decisions that need to be made. So within TRS, you're offered a couple of different options like we just saw. So one option is a single life pension benefit. That's behind to a spouse or a significant other. All right. So with that option, once that pensioner passes away, there's no longer any benefit that New York State is paying out to anybody else. If that happens early in retirement, that can be pretty financially devastating to the household that was receiving that pension or expecting that to come in for the rest of both lives. Another option is to take a reduced pension benefit with what they call a survivor benefit. All right. With the two options that New York State offers, they offer a joint allowance option, which means as long as the state employee or their spouse is living, New York State will continue to pay out the same benefit to either or. The other option is called a pop-up option, which means that if the New York State pensioner passes away, their spouse would continue to receive the benefit or a fraction of the benefit that they were receiving. If the spouse of that New York State employee passes away, the New York State employee, the survivor, would then pop up back to their single life amount. All right, so there's a little bit of flexibility in an inflexible system with that pop-up option. Generally, with the conversations that we're having with our clients and SAANYS members, that's the option that we compare this to the most. Part of the reason is there because we're also having an expectation a lot of times that we're going to have a pension and maybe two Social Securities in the household. For our clients who are experiencing the passing of a spouse early in retirement, we also lose one of those Social Securities. The higher of the two Social Security benefits continues on to the surviving spouse, but we could have a scenario where we go from 3 fixed income sources, the pension and 2 Social Securities, down to 1 or potentially 2 if we do some survivorship planning. So again, all things that we look at there, but different nuances and different inputs that are specific to each individual situation. So again, with the single life pension option, that's where we receive the highest income for as long as that New York State employee is alive. All right, the downside is if there's a passing at any point during retirement where the spouse is still living, that spouse is no longer entitled to any remaining benefit that New York State employee was collecting. All right, so it can be something that can cause quite a bit of financial devastation. The joint life options through New York State, again, the benefit there is we know the spouse will be protected to a certain degree with whatever New York State option that New York State employee chooses. However, the challenge there is that as long as both sides of the household are alive, they're receiving a smaller benefit from what they were entitled to. So again, that's one of the things that we have to look at is how to make sure that both sides of the household will be financially solvent, regardless of what happens as far as longevity, but making sure that while both sides of the household are alive, that we're maximizing the benefits that we can expect from that New York State pension. So it is a bit of a balancing act. And again, there are some solutions to maintain choice, maintain flexibility. So whatever life events happen down the road, we do have the ability to make sure that we can adapt to those changes. All right. So some of the points to consider here. So as we look at the different objectives to pension maximization strategies, there's really three different options. So the first option is to take that single life where we're rolling the dice in that case. All right, so we're rolling the dice because, again, if something happens, there's no longer that spousal income benefit from that pension system. The other option is to provide for the spousal income, right? Provide the benefit through individually owned life insurance. All right. Another option, the third possibility, is to use existing savings to supplement the retirement income, where we can take the single life option and then personal savings will be utilized to offset that that income need in the event that that person passes away. Now, not everybody has the ability or has been able to save over time, so when they get to retirement, they can say, well, if we didn't have the pension, we'd still be all right with the rest of our assets. That's where, again, life insurance is used as that funding mechanism. So if something happens to a New York State employee in retirement, there's a life insurance death benefit that would then pay out to the spouse to provide that retirement income. So we'll show some examples of that, but from a New York State perspective, again, in line with some of those pension numbers from before, if we were to look at the single life option, so in this case, Carl would have a $5,000 per month benefit. And that would be his maximum benefit with no survivorship option included. So if we were looking at a 50% survivorship option, this is where Carl would receive $4,400 a month instead of the $5,000 that he's entitled to. But that $4,400 would carry a 50% survivorship benefit. So if something happened to Carl in retirement, Catherine, in this case, would still receive half of what Carl was receiving. All right. So again, from a financial planning standpoint, this is where we look at a lot of different options, because if we're planning on the life expectancy of our clients being 90 or 95 years old, and we're planning on that $4,400 or even $5,000 a month coming in, and now something happens early in retirement, and Catherine now only has $2,200. Again, that's where there's some difficulties and challenges with the income picture and what the expectations were versus what the reality is. All right. So again, with the different options that New York State offers, on the left-hand side here, we have the $5,000 a month pension while living, the single life option that TRS employee passes away, there's nothing going to a survivor. All right. With the $4,400 a month pension while living using the survivorship option, that TRS employee passes away, that spouse or significant other would continue to receive half of that benefit, which is taxable at ordinary income for the rest of the spouse's life. All right. The alternative there is using that life insurance option to say, well, I'll take the $5,000 a month, I'll purchase individual life insurance and utilize that life insurance death benefit as my funding mechanism for my spouse's future income if I predecease her. So to look at how that would be included, so if we have the single life with the individual life insurance, that we would take that single life pension option of $5,000, the highest income benefit while both the New York State employee or SAANYS member and their spouse are living. If the TRS employee passes away, there's nothing from New York State going to the spouse anymore because, again, we took that single life option. But now we have a lump sum tax-free death benefit that can be utilized to provide that income protection for the spouse or children. The proceeds from the death benefit would then produce an income stream that, again, can be used for the spouse's income, can also be used as a legacy planning tool for children, grandchildren, future generations, whatever it might be. In the event that the spouse of that TRS employee passes away, we have the ability to change the beneficiary on the existing life insurance. Again, something that you can't do with the New York State pension options. We have the ability to reduce or eliminate the life insurance premiums and essentially use it just like the pop-up option, where we can go back to that single life income benefit because we're already collecting that. The other option is to surrender the life insurance to receive the potential cash value. All right, so a lot of times with the pop-up option, what we see through New York State is both of our state employee clients, or I'm sorry, both the state employee and the spouse are living pretty close together in retirement, right? They might both make it to their mid-80s, and there's really not a big discrepancy of when one passes away versus when the spouse does. So we could potentially be giving up $7,000 or $8,000 for a 30-year period where there's really not a lot of income replacement there for the surviving spouse. With the life insurance option, again, you have the ability to make that a legacy planning tool where it's still there as that income producing cash reserve for the spouse, but it can also be used to generate future income for the for again children or grandchildren. There's a lot of different pieces of flexibility and choice that we maintain by self-insuring or using that individual life insurance option that aren't necessarily there if we're using one of the New York State options. All right. So again, there's a whole myriad of different advantages to the pension maximization. Not going to belabor these points here, but it's basically what again, the biggest premise of using a self-insuring option is to try to retain as much choice and flexibility as we possibly can while making sure that whether the New York State survivorship option is chosen or if we do the self-insurance with its standalone life insurance policy, that either way the spouse is taken care of. And if we can filter that pension benefit down to future generations using that standalone life insurance plan, that's a future benefit that you don't have through New York State because it will only cover the New York State employee and their spouse. All right. So we would love to say that pension maximization strategies work for everybody. However, that's not the case. All right. So it depends on a number of different factors. The financial situation itself always determines what makes the most sense in choosing one of the pension options. Health is also another big criteria. If we aren't able to qualify or if we're not in the best health, we might be limited to only looking at what the New York State options are because we may not be able to get standalone life insurance. The financial objectives, the estate planning goals, the legacy planning goals are all other things that we take into consideration. Another option that we've utilized with a lot of our state employee clients is also adding long-term care features to standalone life insurance policies, which help offset future expectations or future potential for any long-term care needs. There is the ability to cover a lot of different family goals and financial goals out there to make sure that a pension strategy is meeting all those different options and all those different objectives for our state employee clients. But it's also determined by what options you have under the New York State plan. So again, all things that we look at, we wish that we could say it's a one-size-fits-all option, but standalone life insurance does does depend on a lot of different criteria to make sure that it works. So when to think about pension planning. So the TRS recommendation, and I know this may be hard to see for some of you, but the TRS recommendation for when you should start thinking about your pension is 18 months prior to retirement. We think that that's cutting it pretty close. Their next step is 12 months before. You should educate yourself about all of the pre-retirement options that you may need to consider. Again, 12 months to go before retirement might not allow you to work a plan or put together a plan that's in line with those overall goals. 8 months before retirement, they recommend reviewing other retirement income. Again, this is something that we always want to make sure, especially for our SAANYS members, that we're addressing years and years and years before the decision is being made. It's very, very difficult to put a plan together if we have a month to prepare for retirement, right? But if we have 3, 5, 10 years to start thinking about when to elect our pension option, what option are we going to select, and put a plan in place to lead up to that, we can create a very, very healthy pension plan to maximize what those benefits that you're entitled to are. So our recommendation is to understand the future benefit expectations now. By even understanding what you can reasonably expect to have down the road, that puts some of the moving pieces in place. Identify some of those different areas where we can potentially maximize those benefits. By looking at the spousal benefits or legacy planning, we have the ability, again, to incorporate some other areas. The closer we get to retirement, the more challenging it is to do that. There's nothing saying that if we're 5 years or 10 years or even 20 years away from retirement at this point, that we should implement anything today. We implement these strategies when the time is right. So again, that could be 5 years, 10 years, it could be the year of retirement when these strategies are right. But again, it gives our SAANYS members the ability to proactively think about these things to make sure that they're taking all the right steps today. The more time that we have to look at the retirement picture, to look at pension planning, the higher chance of financial success we have. All right, so again, another key component there, and this is just, again, to incorporate all those different moving parts, whether it's the pension, Social Security, retirement accounts, spousal benefits through their employers, anything along those lines. Getting all of that in one cohesive plan early on just improves the chances of financial success. So we're going to open it up for Q&A. We're also going to do a more locally based pension planning seminar. So that is something that if you do want some more information on, or you would like to attend that, please feel free to reach out to your local representatives in each SAANYS region here. So again, we're going to be hosting those starting in April, so we can absolutely get that information out to you, or if you would like us to make sure that you're included in that information, by all means, feel free to reach out. But again, we'll leave this up for a couple minutes as we're doing some Q&A. But I guess we'll start that now. But again, in closing, I'll say thank you very much for everything that you do for us as a member, as a corporate member of SAANYS, everything that you do for the school districts, the communities, the kids that you affect every single day. We definitely have a huge appreciation here for everything that all of you do at AXA. So again, thank you very much, and we'll open it up for questions now.
Okay, Greg, we do have a few questions. Paul asks, is there a single life pension benefit with a one-time survival payment, like life insurance?
Through New York State, so you can do something called a lump sum death benefit. So what New York State does is, if a TRS member says, I'm expected to collect $60,000 a year, but at my passing, I want my spouse to get $200,000, they can do a calculation that will reduce that amount. And they'll reduce that amount on a yearly basis. So it might go from $60,000 to $52,000. and then at the time of the passing, that $200,000 benefit would get left behind. That is something that's flexible to do within the pension system. However, what we see is anytime that's done, the cost to take out an individually owned life insurance policy is drastically less than the cost of New York State reducing your pension benefit for the rest of your life. So it is an option, but again, looking at some more individual strategies typically makes a lot more sense, unless again the health or insurability comes into question.
Okay. Elizabeth has a couple questions. First, and you had mentioned life insurance earlier. Her question is, would that be a whole life policy?
It would depend. So some of the planning that we do, because of some of the options with New York State, that if we don't make it to retirement, then there is no pension benefit. Sometimes if we know that we're going to choose a survivor option through New York State, it's just bridging the gap and making sure that we actually get to the point of where we're able to collect that pension. So it could be term insurance, which is more temporary in nature, just to get to a certain point. It could be whole life, it could be variable universal life. There's a whole lot of different options out there. Again, just I guess in full disclosure, we're an open architecture company, so we can use any type of insurance platform out there. So depending on what the situation calls for, we have the ability to implement any specific type of life insurance there.
Okay, and then a follow-up question from Elizabeth. How far in advance should you purchase your life insurance preparing for retirement? At what age?
That's a very, very good question. So the biggest challenge that we have for clients who like the idea of the strategy but want to wait until retirement, the closer we get to retirement, unfortunately, the older we get, the more challenging, the more health issues can potentially come up. Life insurance is based on health and it's based on age. So because of that, the longer we wait, the more expensive it becomes. Again, there's a lot of times where we might use term insurance initially because that's more affordable, or maybe that fits into the budget more effectively. And then we can transition that into permanent life insurance over time without requiring new evidence of health or anything like that. So the earlier we look at options, the more informed decisions we can make. But again, there's nothing locking us into sitting down and going through an analysis and then saying the best option is to wait, until retirement to implement anything. But from an insurability standpoint, the earlier we get it, we know what our health is today. We don't necessarily know what our health will be down the road, so it makes it more challenging with the uncertainty of it.
Okay, and Andy has a question. Says, if the third highest salary at more than 10% is thrown out, do they use the last three?
So if one of the last 3 years is 10% more than the other two, then they will throw that year out and they'll start backtracking to previous years of salary to make sure that they're all within that 10% range of each other.
All right. Another question. For the 3 consecutive years, if one of those three, same question as I start to read it. So I think we answered that question. Let's see what else we have. How can a spouse find out how much she will receive per a QADRO filed against her ex-husband's retirement? That makes sense to you.
Good question. So that's probably a little bit more on the legal side. That would all be determined by a divorce decree and some of the divorce documents. There is a standardized formula called the Majuscus formula that is used to anticipate what percentage will be, but that percentage the actual dollar amount will fluctuate depending on what the ex-spouse's final average salary is and what their pension benefit is. So it's something that that is a little bit more challenging to figure out initially, but I would probably have to say that it's either through an attorney or through TRS. I mean, we could run expectations and calculations for where we might think they are, but the most specific way to get that would be either through TRS or working with the attorney who drafted all the divorce documents.
Okay. Do years worked in New York City count toward the 30 years needed for New York State requirement?
They do. They do, yep. In another topic on, or another piece of that, so any prior years of service that maybe haven't been bought back yet, it always makes more sense to try and buy those back earlier than in the future. Because what New York State's doing is they're adding interest every single year. So if you worked, high school or college job for a county or municipality, and we wait 30 years to buy that credit back, there's going to be 30 years of interest that's attached to that. So we'd like to try and buy that back as soon as possible, so it's less of a contribution that we have to make to the pension system. But yes, New York City credit does count in New York State retirement.
Okay, another question. Can the FAS be calculated at any time during your 30 years or only in the last 3 years?
So they will take your 3 highest consecutive years. That can be years 20 through 22, if those happen to be the highest 3 consecutive years. Generally speaking, for the vast majority of clients and TRS members, it's the last 3 years of working, but it is just the highest 3 consecutive years.
Okay, and along the same lines, how do you calculate the FAS and pension for years 31 through 33 if a Tier 4 member works for 33 years, and those are the highest salary years? Do you want me to read that again?
So the final average, yep, so another good question. So the final average salary will be based on the 3 highest years still, even if they are past 30 years. The pension benefit is what's going to be somewhat affected by that. So for anyone with less than 20 years of service credit, they get 1.66% per year towards their pension. For anybody 20 to 30 years, they get 2%. So if someone works for 25 years, they would be entitled to 50% of their final average salary as their pension benefit. Working beyond 30 years, you still get the 2% for up to year 30, but after 30 years of work, you only get an additional 1.5% for years 30 plus.
Okay, next.
So you still get credit, it still increases the overall pension, but it's not increasing at the same rate that it was prior to 30 years.
Okay, all right, a few more questions. Also, Betty Jean, I know you're out there. I saw your question and it deleted, so if you could resend that, that would be great. In the meantime, we have another question. Is it worth buying back 5 months of service?
It's worth looking at it from the TRS standpoint. So what you can do in that case is the way that you buy back service, there's a service credit buyback form that's accessible online through TRS. And by requesting that information, they'll send a letter in the mail to that TRS member saying, if you want to buy back that 5 months, here's how much it will cost you. We can then run a calculation to determine if that cost today is going to be worth it in the pension increase down the road. Generally speaking, all the service credit, it does typically benefit to buy back, especially long term, because when we're looking at the retirement, you're increasing your pension for the next 30 to 40 years. It's to buy back 5 months, it probably wouldn't be a huge out-of-pocket cost today. And there are ways to use 403B dollars to buy back those previous years of service. So again, those are all good questions. That's something that we can help with as well to help get the New York State number for how much that would actually cost, and then determine if it would make sense and how to repay that to New York State.
Okay, along the buyback lines, the next question is it beneficial to buy back years from 30 years ago? I don't know if it's different.
It still can be, depending on how long the prior service was. If we're looking at buying back 1, 2, or 3 years, it will definitely make an impact. If it was 2 months from 30 years ago, again, it might not be as impactful, but those are all things that we can help assist with and do.
Okay. If one is to leave the profession with only 25 years before age 55, would one be able to collect a pension at 55 with or without penalty? How would the FAS be calculated?
So the FAS would still be calculated on the highest 3 consecutive years. If someone were to retire at or stop working for New York State at age 50 with 25 years of service, or age 55, so you still would be entitled to it, but you wouldn't be able to collect it for 5 years. In that case, there would still be a permanent reduction of 27% of what that benefit would be.
Next question. I am 54 years old. I have 1.5 years in service. What is my best option for retirement, and what percent will I get when I retire?
So that's most likely in that case under tier 6. So it would depend a little bit on some of the nuances there. So tier 6 is a whole different kind of tier in and of itself. So there are a couple of options, but by hitting some of the minimum requirements, it still could be beneficial to ultimately retire under the TRS system. Again, that's something that we would probably not be able to retire before age 63 in order to be eligible for any pension benefit. But that's still, again, something that we could sit down and look at what the longevity expectations are for the working life, where we expect to retire, and then ultimately see if it is something that there would be a pension benefit there. Even if we don't end up vesting for the pension benefit in that case, you do get a return of your contributions plus interest that you can move into a retirement account. So it's not like the contributions are completely lost if you don't actually vest for years of service, but it is something that, again, we can help coordinate and help see what the expectations might be.
Okay. We have another follow-up question to the New York City question. You need to buy back time worked in New York City, or does it automatically transfer? Is New York City retirement different than New York State retirement?
So New York City is a little bit different. It doesn't automatically transfer. Believe they still require us to go through a paperwork process, but as long as that service was not cashed out and distributed to the member, it is something where it's more an administrative task to switch that service from New York City teachers retirement to New York State.
Okay. Does summer school salary or after school salary count towards your FAS?
It does, yes. Yep. There are ways, and again, that's one thing that we look. We have some clients that do a lot of that their last year just to try and boost their final average salary. Again, the word of caution there is make sure it still falls within that 10% of the previous year. But yes, any summer school or any regular instructional pay would be included. Any coaching, there's a list that we can get out, or if anybody would like it, again, feel free to email your local representative. But there is a pretty extensive list of what does count and what doesn't. On that same note, Michelle, I'll just add quickly, a question that we do get a lot is, or a comment that we hear a lot is, I haven't started my 403B, or I haven't started saving for retirement outside of the pension system because I heard that reduces my final average salary. That is actually not true. Any personal retirement account contributions do not reduce your final average salary at all. All right, so a little bit of a tangent there.
Okay. And another question, can you explain the credit buyback and how that works?
Yep. So with any previous service, so what? Again, there's a form that's accessible online through TRS. Usually, if you go to Google and even type in New York State TRS prior service claim, you can pull up the paperwork for that, and it's really just going back and saying what either district or what county, whatever prior service you might have had. And in submitting that to New York State, they go back, they do the research with those individual school districts or BOCES or whatever it might be. And they will calculate how many months or years of service credit you have. And then that's when that letter goes out in the mail saying that, based on our records, there's a year and 6 months of service credit. In order to buy that back, it might be $1,500. If you would like to do that, please let us know. And then again, we can make arrangements either to fund that through a personal check. You can do it that way, or potentially have the ability to do that through an existing 403B or retirement account.
Okay, so we have a couple questions. Things that are included in your FAS, like previous questions. So we can send that complete list. When we send you the archive of this webinar, people have asked, is it going to be recorded? Can they get a copy of the presentation? The answer is yes. We record and archive the entire presentation. We can send that to all participants with the slides and a list of maybe what's included in the final average salary, that list. Okay.
Sure.
That should cover a lot. We do have another question. If you reach 55 and do not have your 30 years, can you retire but wait to claim your pension at 62 without any penalty? Or will the penalty still be based on the age of 55 if you don't have your 30 years?
Generally, yes. We don't see that happen often. It is something that we do a little bit of additional digging on, but generally, yes, we can delay the pension if there's another expected income source or we don't necessarily need it right away. But generally, yes, you can delay actually collecting it.
Okay. Let me stop a couple more here. And again, I think a lot of questions are what counts toward final average salary. This one's referring to buying back vacation time. So maybe we could send some resources on that.
Sure, and again, that's something that we have a lot of experience with. So for any individual conversations, again, feel free to contact a local representative or get in touch with the local office, and we can always sit down on an individual basis and help with that paperwork and help with the process there and determine if it is something that makes financial sense and will make a difference in the pension.
Okay, one or two more questions here. I worked for ARC and BOCES while getting my master's in 1997. My New York State retirement profile lists my date of membership as 1999. Why wouldn't they start my years of service in 97?
From my understanding, the Schenectady ARC would not be part of the New York State pension, but BOCES would. So because some part-time positions or some non-full-time positions didn't require someone to be vested in or become a member of the TRS pension system, they may not have started membership at that point, but that is service credit with BOCES that would be able to be bought back.
Okay, and then lastly, can you work with a couple where there are two different 403B programs, two Social Securities, and an online pension to assess the best retirement for both, including the use of both 403B vehicles, even though they are not both with AXA?
Yes, we would. Yep. So that's really the biggest component of what we do is there's a lot of different retirement income sources. And again, just to name a few, it could be the pensions, it could be Social Security, retirement accounts, part-time working retirement, anything along those lines. Where we focus on and where we specialize in working with our clients, and again, especially SAANYS members, is looking at how all these different moving parts of the retirement picture are hopefully working together, right? So that's going to encompass what option do we elect once we do start collecting the pension? When do we start collecting Social Security? How do we maximize benefits and potentially stagger benefits through Social Security to make sure that we're maximizing what we can expect there? And then ultimately, what are the distribution needs of those 403Bs to see when we may have to start collecting or taking distributions from those? Will that be early in retirement? Will it be later in retirement? Again, a lot of the work that we do with our SAANYS members is centered around distribution planning, and that encompasses all these different facets of the retirement picture, making sure that all the different moving parts of that picture are working in line with one another.
Okay. All right, I think that's about it. Lots of thank yous, Greg, came through the Q&A for the presentation, so thank you very much. And to reiterate, this will all be recorded and we'll email all registrants the presentation. And I think that's it for today. And we did discuss earlier that AXA is going to be potentially putting together some local in-person workshops on this topic as well for more questions, more in-depth look at this topic of pension maximization. And don't forget to join us for next month's Financial Friday webinar on student loan forgiveness, and that'll be on April 13th. And with that, we'll say goodbye, and we'll see you next month.
Thank you, Michelle.
Thank you.